Risk in capital budgeting. This is a big issue when we're talking about capital budgeting because there's a lot of risk. There's a lot of risk because we're talking about large amounts of money, and there's a lot of risk because we're talking about long periods of time, and there's a lot of time for something to go wrong during that process. But what we're going to talk about here are some of the tools that we have available to help us kind of analyze that risk. We'll talk a little bit more about adjusting the discount rate when we're talking about net present value, and just kind of this whole issue about risk surrounding our capital budgeting. And one of the ways we can see this risk and kind of measure this risk is in the variability of potential returns, those potential cash flows. And we know that there's always variations in what the result is going to be. We launch this new product and everybody loves it, and sales are greater than we expected. We launch this new product and nobody likes it. We launch this product at the same time the economy starts going well, or at the same time the economy starts going poorly. And so when we start looking at what are those expected cash flows in the future, even though only one number goes into our capital budgeting calculations, there's a variation of what it could be. It could be really good, it could be really bad. Now somehow we've done that expected value calculation to put one number in. But there's a tremendous variability of what it is that the return could be. And also, as we go further out into the future, we probably get a higher amount of variability because there's more time for things to go really, really well or really, really poorly. And so what we need to be looking at is how it is that we're able to put all of this information together to come up with the best expected value, to come up with the best numbers that we're going to put into all of these calculations. And so when we're talking about those cash flows that we're going to use in calculating each year's expected cash flows, there's a lot of things that we need to be looking at. We need to determine what influences are affecting those net cash flows of similar projects in the past. What is it that's influenced us most in the past? Economic conditions, labor conditions, international conditions, the market, competitors. What is it in the past that's caused those results to change? Now, this doesn't mean that those same things are going to be what causes it in the future, but it's a good starting point. We need to determine the probabilities of each of those influences or events occurring. And then we need to make assumptions about the effect of each of those items on our project. Now, again, we're talking about lots of different things that might influence this project. And so there's a lot of different things that could impact what it is that we're going to be, taking into account, how we're going to take those into account. And we'll talk about some of the tools that we have available to us to help us do that. But first, let's just look at an example here where we're looking at two different capital budgeting proposals, both for one-year projects and both requiring the same investment. Now, we've made several forecasts for the cash flows, and we have if the economy is in deep recession, mild recession, stable, minor expansion, or major expansion, and what the cash flows of those projects are going to be. Now, Project A and Project B both have the same expected cash flow if the economy is stable. But Project B has smaller cash flows in a recession, greater cash flows in an expansion than Project A. So we've got the same investment being made. We have slightly different cash flows based on the states of the economy. Now, what we have so far is just what those states of the economy are. We need to talk about the probabilities. So, companies' economists forecast that the probability of a deep recession is 5%, mild recession 10%, stable economy 50%, minor expansion 25%, and a major expansion 10%. So with those probabilities for each of those different states of the economy, we can calculate the expected values of the cash flows for each project. And so we put it through, we do each of those calculations, we have all of the math there, and what we end up with is the expected cash flow for Project A is $312,500. The expected cash flow for Project B is $325,000. So a little difference between them, but there is a difference between them. But what we see here in terms of the risk is the dispersion of those possible outflows, those possible cash flows, those possible outcomes. Project B has a higher ceiling and a lower floor, just a greater range between them. Project A has less risk because there's less variability. There's less variability within Project A than there is with Project B. So Project B, higher expected cash flow, but greater risk because of the greater variability. It might only be $100,000. 5% chance of $100,000 in Project B, and in that same economic environment, Project B would have a $200,000 cash flow. Now, this doesn't tell us which one we should invest in. It's just part of the tools that are available. So when we're looking at all of these different impacts, all of these different events, occurrences, situations that might impact our cash flows, we need to look at some of the different techniques that we have available to help us analyze this. And there's, again, the issue is we have so many different factors, so many different things that could impact this, and we have a lot of tools to try to deal with that. And so we need to try to match up the appropriate tool, the appropriate scope of tool with what it is that we're looking at. But we're going to look at 4 different techniques. We'll talk about sensitivity analysis, scenario analysis, simulation analysis, and Monte Carlo or what-if risk analysis. And so those are the 4 different techniques that we're going to talk about, and they're all, in a sense, variations on a theme. The first one we talk about is sensitivity analysis. This determines how cash flows change with the change in one of the underlying variables or assumptions. Okay, we've got some variable, we have some assumption, the one we just did, the economy, the states of the economy. We're looking at what happens to those expected cash flows when we change one of those. And as those cash flows change, what happens to net present value, what happens to internal rate of return as those cash flows change. And so we're taking a variable, we're changing it, we're changing one at a time. When we're doing sensitivity analysis, we're doing one at a time. We're changing it, calculating net present value, internal rate of return, changing it again, calculating net present value, internal rate of return, and then changing different variables. And so as we go through this, looking one variable at a time as we go through and how that one variable impacts those expected results, we can find out what's the most important variable, what's the variable that changes the expected results the most. We may also identify something that, we didn't really think was that significant, but as we change that variable, we see it does have a significant impact on the expected cash flows of the project. And so we may get some new information out of that. The second technique is scenario analysis. The net present value or the internal rate of return is analyzed under a series of different specific scenarios based on macroeconomics, things specific to the industry, things specific to the company. We just change all of these different scenarios and we run the net present value and the internal rate of return. And so revenues, expenses, and ratios are estimated. Net present value, internal rate of return of the project under each scenario is estimated. And so we're not going to make our decision based on one specific scenario. We're going to look at all of them and we start to say, wow, like we just did, project B may have more upside, but it has a lot more variability. Okay, this one's got less variability, less upside, but we're looking at all of these different scenarios. We're just collecting more information and looking at all the different scenarios that could happen, how these different projects are going to respond under those. The third technique is simulation. We're allowing for more than one uncertain element at a time in the analysis, and so simulation analysis is more comprehensive than sensitivity analysis because we're taking into account more than one thing at a time, and kind of following along with it being more comprehensive, simulation analysis is also more expensive, and we're generally going to be using simulation analysis only for larger projects. Okay, and so there's kind of a key phrase for you in the exam. If there's a large project, simulation analysis is probably the tool that we're going to be using here. Then simulations are used to develop all of the possible outcomes, statistical methods, taking those different outcomes, calculating net present value, internal rate of return. And again, what we're able to do is take all of those simulations and look at all of those simulations across all of those runs that we've had. And so it's those summary statistics, those kind of overall results is what we're going to use to make our final decision. Instead of, well, this specific situation, we're looking at all of these different situations and what we can kind of expect in general to be happening. Our fourth tool is what is called Monte Carlo simulation. and Monte Carlo simulation is that what if type of analysis that we use randomly generated values for different probable inputs, and we're just running again and again and again and again and again and again. Okay, we're calculating all these expected values in a complex situation. We don't have predictable relationships between all of them. And so we're just running it. We may change things as we go through it, but we're just running as many times as we can, all of these different variables to, again, try to get a sense of the project as a whole. Not under one specific situation, under one specific event happening or not happening, but taking all of those possibilities in terms of what it is that might be happening and what it is that we might be doing. Now, a term here that we're going to put in here is we're talking about all of this issue about risk, and we have to assess this risk, and we have all these different tools. And ultimately what happens is we put numbers into our capital budgeting, and we make a decision. Okay, we may spend a lot of time analyzing it and agonizing over how we're going to analyze it, but ultimately we have to put a number in. We have to make a decision about project A or project B or project C. And then we're going to invest. And then time passes. And all of those estimates, all of those expectations, simulations that we ran suddenly have actual data with them. And so another final step kind of in this whole capital budgeting process is what is called a post-completion audit, where we compare the actual benefits and costs of the project with the original estimates. Okay, we should do this for all large projects, all important projects, no matter how big it is, if it's a strategic project. Do it for some smaller ones, just kind of get a sample of that. But what this does is it helps management know how well we did. We had all of our estimates, we had our predictions, we had our models that we used to project out into the future. How did we do? Did we do well? Did reality match what it is that we expected it to? Was it close to what we expected it to do? Because if it wasn't, if we messed up, if something went, we need to look and see why. Because maybe there's something we failed to take into account completely. Maybe there's something we took into account, but we didn't take it into account correctly or enough. And so what we need to do is use this post-completion audit to improve going forward. To identify what are the things that, we haven't taken this into account in the past, but we really better because we found out this is the most important thing to determining the result of the project. Okay, so it's going to give us that feedback as to how all of those analysis tools, all of that assessment, all of those simulations, were they accurate or not? Were they helpful in making the decision or not? And if not, what is it that we can do differently going forward to get better analysis, better simulations, better information to make our decisions with? So, summarizing here, the different techniques we have to analyze risk: sensitivity analysis, scenario analysis, simulation analysis, and Monte Carlo. All kinds of variations on a theme. Okay, simulation is more complex than sensitivity analysis. Monte Carlo is more complex of all of those. But these are just the different ways that we can analyze all of those different factors out there to try to get a sense for what we can expect those future cash flows to be. Okay, so we can make our decision. Now, we've talked here about risk, and we've mentioned this in the past, but we want to come back to talk again about the process of adjusting the discount rate. When we have a high-risk project, we can use a higher discount rate to analyze it. The higher discount rate we use, the more likely that project is going to have a negative net present value. Because the higher the interest rate, the higher that discount rate, the smaller those present values of future numbers become. And so if there's a lot of risk, we need a lot of return. And by using that higher discount rate, that's that required return we have. That's that higher rate of return that we need to justify making the investment that has the greater risk. And so we can increase the discount rate that we're using to make our calculations. When that risk adjustment is an increase to our weighted average cost of capital, that's called a risk premium. Okay, we may start with our weighted average cost of capital and then add a risk premium to that. But when we're talking about making adjustments here to the discount rate, the discount rate should not be adjusted for non-market risks that are unique or diversifiable. Okay, if we have something that's a unique market risk or something that isn't able to be diversified, the expected cash flows need to be adjusted to reflect those risks. Okay, but what we're looking at here is we're adjusting the required rate of return, that discount rate, for the risks connected to this specific investment. Okay, how we're going to raise that rate to make that. Now, we can adjust this because net present value is a dollar amount. Okay, all of these different cash flows have dollar amounts, and when we start adjusting discount rates, if we want to get really involved, we can also use different rates for different cash flows, different components of the whole project. We can use different discount rates to calculate the present values of different cash flows throughout that single project. So we may say this has a higher risk, this has a lower risk, whatever the case may be. Now here's the example of this. The cash flows from the depreciation tax shield. That's going to happen. Okay, we know that. We bought the asset, we're going to depreciate it, there's going to be depreciation expense, and this is going to be the tax rate on that depreciation expense. We know that. That's certain. But what about those operating cash flows? Are we really going to have that amount of money going forward? Well, we can use a lower discount rate for the depreciation tax shield and a higher discount rate for the operating cash flows, taking into account the risk associated with each of those different cash flows happening. We know that the depreciation tax yield is going to happen. Those operating cash flows in the future, well, we think, we hope, we're doing everything we can, but maybe a slightly higher discount rate for those operating cash flows in the future. But we're just able to make adjustments to individual cash flows as well as just overall cash flows. Now, we said that if we adjust the weighted average cost of capital, that's called the risk premium. Sometimes we want to use the weighted average cost of capital without any adjustment. We'll use our weighted average cost of capital as that required rate of return. Now, in order for us to use the unadjusted weighted average cost of capital with no adjustments, we need to have two conditions. First, this new project must not substantially change our operating environment. Okay, we don't want to introduce any change or risks here because of this new project. And the new capital must be raised in the same proportions as the existing capital so that our financial risk remains the same. So if we have a project that isn't new to the company, just kind of another process that we've been going through, we may use an unadjusted weighted average cost of capital as our hurdle rate. But if it's introducing new risk to the organization, we're going to have to do different financing than usual, then we're going to have to adjust this weighted average cost of capital for it to be connected to and relevant to the individual investment that we're looking at. And we have a few examples here just to kind of go through how this goes together. The first example, a company is considering a new project that involves entering a new market where competition is stiff and the risk of failure is high. Because of these factors, the project will add significant business risk to the company's operating environment, and as a result, investors will require a higher rate of return to compensate. The firm's weighted average cost of capital will increase, so management should evaluate the project using a higher required rate of return. High risk of failure, it's going to add significant business risk to our operating environment. Investors require a higher rate of return. We need to increase the rate of return that we're using to evaluate this project. The second example, a company decides to use more debt to finance a new project than it has in the current capital structure, thus raising the amount of debt in its capital structure. Up to a certain point, additional debt is not a problem for the company or its investors. However, if the proportion of debt in the company's capital structure becomes too high, investors will become more nervous because of the increased possibility that the company might not be able to service its debt and could go into default. Under such conditions, potential investors in new debt to be issued will require a risk premium to invest in the bond. The rate of return that the company will have to pay on its debt will increase. The cost of the firm's equity will increase as well because the equity investors will require higher expected rate of return to buy or hold the stock. And so as a result, the company's overall weighted average cost of capital will increase. So again, a higher discount rate should be used in the capital budgeting analysis. Okay? Just as we're borrowing for this project, our capital structure is going to change. And so we're going to have to adjust the required rate of return for that project as well. And the last example, a company decides to replace an old machine with a newer model. This change will probably not alter the company's operating environment and therefore carries little risk. Management would probably use its weighted average cost of capital as the required rate of return for discounting the cash flows from the new machine. That is simply replacing an old machine. Okay, nothing changing here, just kind of business as usual. Assets need to be replaced. This is just kind of that ongoing process. But if the company is considering a new machine to enter a new line of business, the project will most certainly introduce uncertainty and risk. Because of the increased risk in entering a new line of business, the company's required rate of return would be higher for the new machine purchased for that purpose. Management would therefore use a risk-adjusted discount rate to analyze the purchase of that second machine. Okay. Risk in capital budgeting. It's a big issue. A lot of money, a long time period being involved. The techniques that we have to analyze that risk, sensitivity analysis, scenario analysis, simulation analysis, Monte Carlo. And we can also change the discount rate that we use. If we're doing net present value, you increase the discount rate that we use to adjust for the risk that comes with this project. More risk requires more return, and more return shows up in that higher required rate of return. Again, we've talked about risk in other places and adjusting for it, but this is just kind of putting this all together in terms of the uncertainty that comes with those future cash flows. And some of the tools we have to analyze that uncertainty to try to come up with the best expected cash flow number to go into our analysis, to go into our net present value, to go into our internal rate of return. Because really it comes down to that analysis we do, that net present value, that internal rate of return is only as good as the numbers we put into it. If the numbers we put in are not really accurate, don't really represent what we expect to happen in the future, we're making the decision based off of bad information. So we need to analyze that risk, use these tools to make certain that the numbers that go into our calculations are right, adjust that discount rate for net present value as we need to, and that's going to put good information into the system, which is going to put good information out. And so in this situation where we analyze that risk, take it into account, we're going to be making good decisions based on the good information that we're putting into the different models we use.